Does whole life insurance actually work when our goal is cash value? Meaning the sole reason why we're taking out a life insurance policy is for the cash value benefits. Well, in today's video, we are going to look at a policy that I put in place a little over 5 years ago, working with a gentleman who is a very nice guy. He started his policy back in 2017. This video will be a treat if you'd like to see the recent performance of whole life insurance policies. It will really speak to the importance of properly designing a policy, which we hit on during our last video, really the difference between what is projected on an illustration and then reality. So the policy, when the individual started, he was 45 years old and the start date was 2017. The policy date is June 2017. However, he started his policy, he actually made his first payment a few months after June. I'll hit on why that's important to note, just when you look at the cash value and the actual performance. Now, he had a specific plan, and this is a beautiful case to look at because he had a plan and he has stuck to it. He has done exactly what he planned to do. Now, when we first set that policy up, we're going to walk through what his original plan was, how he structured the policy, and then what it is actually doing today. So his plan was to move $650,000, which was money in cash. He wanted to shift that over to a high cash value life insurance policy. We looked at a number of companies, different ways to set up a policy with different dollar amounts, and he said, hey, here's the plan I like. If I move 650 grand over to a policy, I'm comfortable doing it over 5 years. So over 5 years, that comes out to $130,000 per year. And after that, I don't want to pay anything else into the policy. Maybe, like I want the option to continue to add. And right now, his anniversary date's coming up. He's kind of at that point. It's like, I don't know if I want to add more money or not. Let's see options. We're going to look at options to see what it looks like if he continues to add. But this was his plan, and he's done just that. He's made 5 full payments thus far. So his goal, again, was to maximize the cash value. Why he was attracted to the product is as follows. Safe, liquid, tax-free area to position money. Safe, the net internal rate of return will produce somewhere between 3 to 5%. We are going to look at the annualized internal rate of return in this example. It's a little over 4%. It's performing quite nicely. 45 years old. He did receive an ultra preferred health rating, which health ratings don't make a huge difference when you look at setting up a policy properly, but he did receive the top health class. Liquidity. That's very important to him. He hasn't used the money yet. However, he wants that access. So the policy design was critical here, but he wanted access to his cash value for real estate opportunities. And we're also going to look at income down the road when we start to look at the different options here, the different scenarios. Real estate, we're going to look at loan models, and then also income down the road. We'll look at that in our next video. But liquidity was important to him. And then the tax-free piece, that's a no-brainer. Yeah, that's huge. I recently connected with him actually, just as we had a review call, and he said, with the income projections coming out, if I start at 62 or 70, whenever I start, what taxes do I have to pay there? It's tax-free. I like that a lot. Just because of all the uncertainty going on with the stock market, tax brackets, everything. Here's something where he's got guarantees associated with the product, and the distributions are tax-free when he takes them out, provided we don't trigger a taxable event, like lapsing the policy with the gain, a modified endowment contract, none of that stuff. So before we just jump into the policy, let's walk through the design, because this individual was fairly analytical. He had a lot of questions, and one question he asked a number of times was, Steve, is this policy truly set up in my best interest? Cash value speaking. I want maximum cash value from start to finish. Is it set up in my best interest? So asking that personal question, have you ever asked someone that? Is this truly in my best interest? When you say yes, if you tell them yes, it's set up in your best interest, and then they go to someone else who shows them the exact same product with the same company, same dollar input, but more value from start to finish, that's where all of a sudden they're going to question you, either your knowledge or your motives there. So we have to know our stuff in these particular cases. So he is paying in $130K per year for 5 years. So the question is, where's the money going? Of that $130,000 per year, the company choice he made, we looked at a couple companies, he selected MassMutual. And I had actually met this gentleman, nice guy. He was a referral from someone else who had selected a different insurance company, Guardian. So just in our process, looking at different companies and products, his particular preference was MassMutual after seeing all of the different options. And he allocated of that $130,000, the minimum MassMutual would allow 10% toward the insurance premium, which comes out to about $13,000. You'll see it's a couple bucks, it's $13,050 when we go through the breakdown of the policy, but 10% of the total $130,000 was directed toward the premium. There was a couple $1,000s that was allocated toward a term insurance rider as well. The purpose of a term rider is to raise the death benefit, which was not his primary concern, but what has a direct relationship to the death benefit, I just gave it away, direct relationship to the MEC limit on a life insurance policy is an individual's age and death benefit. So the MEC limit here was $130,000, a little bit more than that, and we're going to show you the exact MEC limit. But being that that MEC limit has a direct relationship to the death benefit, if I go too high on that death benefit, and let's say my MEC limit's 150, it's okay to have extra MEC space, but what does that mean? Well, if I've got more death benefit, it's going to cost me more. If it costs me more, and I pay the same dollar amount in, what's going to happen to my cash value? I'll have less. So the question is, what's the minimum death benefit I can have based on this payment I'm making of $130,000 per year? So the IRS still considers my life insurance policy life insurance, and I reap the tax-free benefit, and not a modified endowment contract where I have to deal with taxation on the gains if I ever want to access the funds. So his MEC limit is $130,000. 10% of his payment was directed toward the premium. It's about $13K. A little bit toward term. I'm just going to round off here. Call it 1090. A 1090 split is what we did here. 10% premium, 90% PUA. Now, premium dollars we'll refer to as the initial insurance expense. So we've got a traditional long-term performing whole life insurance policy. When I say traditional, it's referred to as an L100, meaning he can pay into it until he's 100 years old. Not many people do that, but premium dollars do not show up in cash value in the first and second year in this policy. The reason why is because the insurance company is overcharging us for the cost of insurance or death benefit up front. Now, as he continues to make those premium payments, and you'll see this when we can track what actually happened each year, beginning year 3, those premium dollars come back to work for me. They show up in cash value. It's money I can access. Things get better and better as time passes. Then I've got the paid up additions rider, PUA. I'll refer to this frequently as a cash dump-in. The reason why I see this money show up in cash value. Depending on the company and product you select, in the first year, you'll see between 90 and 95% of that payment show up in cash value, especially with newer products today. It's going to depend on the company and product you select. But on average, in the first year, you see the majority of it show up, and then you begin to receive the guaranteed rate, dividends on that, and it accelerates the growth quite quickly. This is the key to accelerating the cash value on a life insurance policy, the cash value growth that is. It does buy you some death benefit, which I'll go through how that works in this example as well, because you're going to see a level death benefit initially. So let's have some fun, shall we? Let's first look at the original illustration here. So when he started his policy, it was in 2017. So 2017, let's validate that. If you're familiar with MassMutual, you can tell by the logo, right? The older logo that they've updated since. But we can see right here that this illustration is based on what? What do we see here? Look at this. 2017 dividend schedule. So 2017, what was MassMutual's dividend interest rate? This is going to be important here. Dividend rate in 2017 was 6.7%. So when we look at this projection, as the years pass, what's going to happen here is the numbers assume that that 6.7% dividend rate remains intact forever. That doesn't happen. Has not happened in this particular case. So let's continue on here. Before we go further, what I do want to hit on is this guy here, MEC limit, just over $130,000, which means we solved for the minimum death benefit possible to be able to pay in $130,000 per year. So if we scroll back up now, net death benefit is what? Far right, $2.75 million, age 45 male. This is an older product with a 4% guaranteed rate. Over here, where's my money going? Here's my premium. Of the total payment we've got right here, $130K per year going in, there's the underlying base premium. Just over $13,000. The lowest Mass Mutual will allow us to put it or set it is 10% of the total payment. They will not allow us to go any lower. If you do go lower than that, we can illustrate it, but you'll see a warning message at the end of that illustration stating this policy will not be approved for sale. Please fix it, more or less. They don't say please fix it, but they're not going to approve it. So there's the base premium. Then here, let's do this. LISR, LISR, Life Insurance Supplement Rider. We see just over $2 million here. This is term insurance. The term insurance does not cost him $117,000. Cost a little over $1,000 in this example. So this is a combination, might be a little bit more than $1,000, but it's a combination of term insurance and then money going toward that paid-up additions rider to accelerate the cash value growth. Now, when you add those two death benefits together, you get $2.75 million, which you'll see over here. This term rider of $2,062,500 is referred to as a one-year term insurance rider. How it works is as he continues to pay money into the policy, remember where we mentioned that PUA rider, when you throw money into PUAs, goes into cash value, but it gets you some death benefit as well. So on average, if he throws in $100,000 into a PUA payment, that'll buy him about another about another $300,000 in death benefit. So as that whole life death benefit goes up, the term amount comes down. And you can actually see it right here. Look at this. Day 0, before I pay anything into it, $2,060,000. He makes a payment of $130,000. The majority, a little bit more than $100,000 went toward PUAs. Look at his term rider over here. Down to $1.7 million. So by the amount the whole life death benefit has increased, the term death benefit has decreased proportionately, keeping you level at the 2.7. And it will remain level with this type of design until it A, naturally expires, or B, we cut it, like we see here after year 7. Why it's after year 7 has to do with that MEC test on a policy. The 7-pay test is another name for our MEC test. First 7 years of a life insurance policy. If I drop the death benefit, in many cases, I'll run into a MEC situation. So here's my $130K per year payment. Let's hit on the point he was interested in. $112,000. This was the illustration. So this is what was projected. $112,000. Policy date, June 2017. He made his actual first year payment several months later. I've got to go back and look at the notes, but it was either August or September, something like that, a couple months after the fact. So what that means is if you start a policy, this is only effective when I first start a policy with Mass Mutual in this case. When I start a policy, if I pay late, so I've got a start date of June, but I actually make my payment in September, this would apply if I backdate a policy. The base premium is effective based on the actual policy start date in June. However, PUA payments are effective based on the date I actually send the money to the insurance company. So the illustration projects $112,000 in change after one full year. However, in reality, if I make my PUA payment a little bit late, that means the money got there a little bit later. They're going to begin to apply any interest on that a little bit later. The first year is just the guarantee, but you'll see a little bit less in the first year as a result of that PUA payment being made late. Some additional information. We talk about other insurance companies, Guardian, being very flexible with their PUA rider. So with Guardian, if you add PUAs at discretion, what you see on an illustration the values on an illustration assume you make those PUA payments every year on the anniversary date, or if you're just adding at discretion, you'll have a little bit less in cash value than what that projection shows. Because PUAs begin to receive dividends, the company begins to apply dividends and interest on PUA payments based on the date of deposit, where an illustration always assumes PUA payments are made up front. Little tidbit of information that's good for awareness, just so we can understand why I have a little bit less money sometimes if I'm making late payments, specifically with PUAs. But to get back on track, 130 year one, 112 in cash value. What did not show up? Primarily the base premium, then the term rider, the PUA fees. Year two, I pay in 130. It grows from 112 to $230,000. Did he get the full 130 back? No, he did not. What did not show up in cash value in the first and second year was that base premium with this particular policy. How about the next year? He pays in how much? 130 again. Cash value grew from 230 to 367. If he just stuffed this under his mattress, if you had 230, you pay in 130, you put 130 under your mattress, the next year what would you have? Earning 0%. You have 360. He's got 367. So at this point in time, the base premium is coming back to cash value for you in addition to earning the guaranteed rate. You're also earning dividends now each year, so it gets better and better as time passes. However, if we look at his total payment, if we look at each year, by year 5, he's paid in a total of what? $650,000. How much does he have in cash value? $668. So he's positive by year 5. That's a healthy break-even point with a long-term policy. Did that actually happen, though, is the question. Because this assumed each year that 6.7% dividend rate was applied to this policy. What happened with the actual dividend interest rate with the insurance company? Interesting stuff to actually dig into this, isn't it? So let's take a look. Here we've got, over here, oopsie daisy. There we go. What do you notice here? 2017, when he started the policy, dividend interest rate was 6.7%. 2018, the next year, dividend interest rate came down to 6.4%. How about 19? Was the same thing, 6.4. Then what? 2020, 6.2. 2021, 6%. He's about to enter policy year 6. So this is what happened year 1, 2, 3, 4, 5, and then year 6, a 6% dividend rate will be applied to his policy. So, again, what's actually happened with performance? Here's the fun part. What you can do to get the values on this, so we like to really dig into this. The first thing that's typically done, this should be done every year, is what's called an in-force illustration. So this is a new in-force illustration. You can tell it's new based on the company's dividend interest rate, based on the company's logo. You'll notice it's a bit different here. They've updated it. What's consistent here, same premium. You'll see this lister payment is 0 because he plans on paying nothing this year. He can increase that if he wants. We're going to look at that shortly. But year 5 over here, what do you notice? Nothing going in because he's already made that payment. June of 2021 is when he paid that $130,000 into the policy. And I remember talking to him like, hey, I've paid my last payment here. What do things look like moving forward? Can I add more money? We'll look at things as the years pass, but my plan was to stop at this point in time. Can he do it? Yes, easily. So here we go. Net cash value at the end of this year, which will be June 20th, we're shooting this video on June 10th, so we'll track the values to make sure it actually hits this, but it will. Well, there's no reason it shouldn't, just when we track performance year over year. But 657. So that dividend rate has come down, right, substantially. It was 6.7%. It's come down 70 basis points over the past 5 years. You've seen that with most insurance companies, reductions as a result of the low interest rate. But he's paid in $650K. He's still positive at this point in time. Break-even point achieved. Year 5 was projected. Year 5 has occurred. When policies are properly designed, we see that actually occur. $2.75 million death benefit, that's the same. Terms reducing at a healthy rate, which is exactly what we want to see there. That keeps the cost low as well on that term rider. And then what do things look like moving forward? So we see the next 2 years, annual outlay, 0. Here, you see this column, annual surrender. This represents the base premium of $13,000 and change that's still due, but he's not paying it. The policy is paying for itself through dividends and interest, yet his cash value continues to grow. We see next year grows by about $30,000 with no payments going in. So that's the net growth based on the 6% dividend interest rate of 2022. Then the following year grows from 687 to 719, a little bit more than 30K. Next page. Well, first off, here we go. There's a 2022 dividend schedule. But next page, reduced paid up option in year 8. This is optional for him. So as we're discussing the actual performance of the policy, a reduced paid up option, it's going to take me a while to get used to this. That's okay. A reduced paid up option eliminates the premium altogether. So once that reduced paid up is exercised, this is always a choice that's made after starting a policy, we won't see that annual surrender column anymore. It eliminates the premium altogether. The policyholder forfeits the right to add anything else to the policy. He can still borrow and repay. He can take income down the road. I like to refer to it as cutting the drag, meaning we're eliminating the premium, so our dividends do not need to pay a premium for us. The only drawback here, or the thing we want to be aware of, well, is 1, the death benefit will reduce, but 2, once we do this, we can't turn back. So if we ever want to add anything else into the policy again, I wouldn't do this. If you want the option of potentially adding money, I would just continue to do what we saw on the last page, allow the policy to pay for itself through dividends and interest. That's referred to as a premium offset. Cash value, though, here continues to grow. So this is great because we can see it's still broken even year 5, and we see what things look like moving forward. What it does not show, however, is what's happened years 2, 3, 4, and 5. Well, this is year 5 we saw here, but all of the years in between when we look at the actual performance, because in-force illustrations do not show that. Call it a historical illustration or actual policy where we can see the values year over year. Companies don't provide that kind of stuff. I wish they did. It is something that our company does. We're starting to implement it for everyone we work with. And here's what happens, right? So if you're in the industry, you may or may not appreciate this. What we do is pull the annual statements for the client. So we've scratched all of his sensitive information. But here's his first annual statement. So we started the policy in June of 2017. You'll see the anniversary date here, or information as of June 20th, 2018. So this gives us all of the values. Remember that PUA comment I made in the first year? If you make a late PUA payment, you have a little bit less cash value than what the projection displayed. Here you go. A little bit under the $112,000 that was projected because he made the PUA payment a couple months late there. So as long as people have awareness to know, okay, that's why I've got a little bit less. When you look at illustrations, they're always accurate year to year. Some clients we work with have made comments stating that illustrations are no longer valid after they're printed. Not true. They're valid year to year, just understanding when dividends and interest is actually applied to PUA deposits, premium deposits. If I'm making monthly payments, like I've got to dig in and understand how it works. So here we go. That's my value at the end of the first year. Let's continue on here. Next year, 2019, dividend came down. Next year, we've got June 2019. If we go to the following year, we've got 2020. Let's scroll down here. There's our value, right? We see at the end of 2019, then the end of 2020, appreciating as needed. We can get the dividends actually on the next page, so we can see what was actually paid with respect to a dividend. Not always easy to navigate through these because it's all jumbled together. $7,800, that's the actual dividend that was paid. Remember the dividend rate this year? 6.4%, gradually coming down. And then we've got the remainder of the annual statements. But this can be a lot. So do you think a policyholder, do you think it would be appropriate if I said to him, yeah, you can see your past performance on the annual statements you get each year? Imagine if I said that to you, like, okay, like, what do I have to page through each one? Like, that's going to take a lot of time to sit down and understand that. Really, your agent, the person you're working with, should work to make things as convenient as possible for you. So here's what we do in this particular case. Here, we've got the historical illustration. So we export the values, one from the annual statements here. Sometimes we'll add the dividends. In this example, we did not, just to keep it simple. But here we go. Annual outlay, could have put the calendar year as well, but just kept it simple here. So let's get this out of the way. 130 in from that annual statement, 111,842. Each year that has passed. Total payments here, break-even point, 657. If we're working with someone that has a loan outstanding, what we'll do here is show it sometimes with the loan or clear the loan so we can see what our net cash value is without any loans. That's fairly simple to do on an in-force illustration, but he has not taken any loans yet. So we've got here, original plan. First 5 years already in the books. This is his real value up to this point in time. Well, right now it's $640,000 and change. When dividends are applied, end of year 5, it should hit that 657 and change. Now, nothing thereafter. Again, the original plan. There's the reduced paid up after year 7. Cash value continues to accrue. Of course, we need to track this each year as the dividend rate adjusts. If it does, it probably will. But had a conversation. He asked, well, what if I pay different dollar amounts in? Can I still add money? I'm not sure if I want to do that yet, but let's see what it would look like. So what would it look like? $130,000. 5 years. Already did that. What's it look like if I throw another 100 in and then just pay the minimum premium? So if he throws another 100 grand into the policy, what do we see here? Grows from 657 to 785. Do I get that full 100 back? Yes. If it was just the 100, it would grow from 657 to what? 757. I get that plus almost another 20K on top of it. Then next year, just the premium could be 0 that year. Grows to 836. He can keep paying this premium if he wants to. He might elect to do that. He probably won't, just from our conversations. He's at the point where he's like, I'm just about to stop. Maybe I'll add some more money. He has taken out an additional policy on his wife, and we've looked at options on his kids. So if he's going to start more policies, we'll probably be on policy numbers. But what if I add another 100 grand, then the premium? What about this? What if I just make the premium payments for 2 more years? Takes me up until age 52. Track the total payments. A little easier than looking at the detailed illustrations, right? I think it is. But there we go. So these are from in-force illustrations as well, just like we saw before, the first in-force where we export all of the data over to this. But this is a great means to track the actual performance of a cash value life insurance policy, looking at the historical performance. So if you said like, hey, what has my policy actually done? I'd like to see real data. An in-force illustration, that's not going to do it. It's not going to show past years. Annual statements will, but that can be confusing. You're like piecemeal, putting everything together, trying to figure it out. Combined all that, put it here. This helps. It lets us see what has happened and then what things look like moving forward. we can take it one step further. We've done this in past videos, is we like to show, here's the original illustration, here's the new one, here's the dividend difference, so we can see the dividend decline, and then has the impact been real? Like, is it actually doing what it's supposed to? We've got to make sure this stuff is accurate. Last thing I will hit on here, let's hit this guy real quick. The actual growth rate here. What has it produced? All right, so we've got the annual IRR here. Keep in mind, this is the annualized IRR, not the average. Important to note that. The average, if I looked at it year 5, for example, where I paid in $650 and have $657, at that point, I'm finally in the black. The first 4 years, I'd be in the red here. So the annual just isolates what I'm growing by each year. First 2 years are negative as a result of the $13,000 base premium not showing up in cash value. That's the biggest hit there. Yes, the term rider, PUA fees add up as well, but it's primarily the premium. Then the policy's compounding, plus the premium is coming back to work for me. There's the net growth as time passes, based on the present dividend rate of 6%. So we want to track this each year, but it is really starting to pick up the pace now. And we can look at this on each example, which typically we do during our review calls and providing information. So this one was a lot of fun, and we're not done yet, but we are done for this video. I'll say that much. What I mean when I say we're not done yet is we did mention this. Other opportunities, using the policy for real estate, using the policy for income. He had a lot of questions on this. A lot of people have questions on this. Not just seeing that on the original projection, because again, we want to look at reality, what actually happens. So now that he's funded the policy exactly as he had planned, he didn't use any money initially. He could have, but he didn't need to, or he didn't want to. Now we're going to look at actually using it. So next video, we'll have some fun. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.